starting streaming, holding on. Let me see when it comes on. It's offline still.
So you take your remote.
All right, and go.
Good evening, everybody, and welcome to Everything You Want to Know About Managing Your Money. This is presented by Chatham Literacy. Chatham Literacy is dedicated to enhancing knowledge in various areas, such as English, reading, becoming a U.S. citizen, also other life skills like financial literacy, which is what today's topic is. Workshop number 2, this is workshop number 2, and the focus is on financial literacy. My name is Don Fleming. I'm with Homeland Financial and Estate Services, located in Durham. I'm a financial planner and consultant, 20 years in Wall Street and financial consulting. Additionally, I'm a licensed realtor, and I also own my own credit restoration business, where I help folks get better credit and move them across the finish line to reach their financial goals. Right now, I'm on a location at Chatham County Community College in Pittsburgh. Let's welcome our other workshop locations: Holy Trinity UNC, UHC, Siler City, Word of Life Christian Center, Siler City, and Liberty Chapel Church, Moncure. Our presenters for today are Stephanie Perkin, Financial Center Manager, Capital Bank. She's also a realtor and founder and speaker with Live in Victory Every Day. Additionally, we have Lucinda McLean. She is a personal banker at Capital Bank as well. She is a credit consultant, first-time homebuyer specialist and consultant, and she is a business owner. Again, the focus of this workshop will be understanding your credit report and home ownership. With that, I will let Lucinda take it away.
Good evening, everybody. Sorry for the delay. What we're going to start off doing is we want to kind of reiterate a few points from last week's class, and also take any questions that you might have before we get started as for the material from last week. So we talked about money management last week. We talked about opening a bank account, debt cancellation, debt management, and budgeting. So if you have any questions from last week, if you will please let facilitator know. And we'll start with some points on that. The two questions.
As Lucinda stated last week, we did talk about money management. One of the things I just want to briefly go over some of those topics from last week. Last week we talked about your personal relationship with your money. What is money to you? Basically what that entails is that how do you view money? What is your perspective of money? What are your feelings and attitudes about your money? We know a lot of times the way that we actually view money actually stems from how we were actually brought up. So we just want to make sure that you get a personal understanding of why you feel the way you do about your money. Sometimes whenever we grew up in an environment where a lot of people just use money lavishly without really considering about how it can actually help them to get to the next level, sometimes those things can actually stem from there. We actually talked about too, why do you feel the way you feel about your money, and what money is to respect, is to be respected. It's not to be worshipped or to be loved, but it's just to be respected. And we must have a well-balanced thought and attitude about money so that we can make sure that we're maximizing the full value of our monies. The other thing that we actually talked about is, and I'm not going to go over everything, I'm just going to kind of jump around, is planning and budgeting. The other thing that we want to talk about is planning and budgeting, actually having a goal. What does a goal mean? A goal is what you're trying to accomplish, and a plan is actually the actionable steps that you have in place in order to get there. A couple of things I had wanted to actually lay out to you last week about an acronym that we can actually remember is called SMART. When it relates to your goal, to be specific, make sure that your goal is specific, that it is measurable, it's achievable, it's realistic, and it's timely. So just remember that acronym, SMART. Again, make sure that it's specific, it's measurable, achievable, realistic, and timely. We also talked about your needs versus your wants. I think that was pretty direct in regards to that, and like Lucinda said, we talked about too, as far as opening up a banking account and the process that actually entails. Again, if there's anything specifically that you wanted to maybe dive in a little more deeper about that, just let the facilitator know and she'll actually relay that information to us.
I just wanted to add, as far as the budgeting piece that I did not drive home last week, is your budget will change on a monthly basis. So it changes based upon expense increase or decrease. It depends upon life situations, like maybe a job change or an unexpected expense that you're not prepared for. So your budget will change monthly. And make sure you all change the categories on the budgeting worksheet to your specific lifestyle. That was just an example that I gave you last week. And so make the changes accordingly so you can stick to it. And I also wanted to reiterate, excuse me, I didn't say this at all, but the bill that you decided you want to pay off first on your budget, make sure you're putting all your extra funds that you have towards that bill first. Whether it's the avalanche you wanted to go by, whether it's the interest rate plan, or whether it's the snowball effect. And the snowball effect is going to work best for those people that need to free up money. So if your number on your budget was in the negative at the bottom, your expenses was more than your income, then you are that person that needs to use the snowball effect so that you can free up money. Along with, of course, cutting out some utilities, excuse me, not utilities, but cable and things that are luxury items, you know, shopping around for insurance to lower that stuff, you know, cell phone plans. So we just want to make sure that you remember that your budget is going to change every month. So you want to start planning out your budget like the last week of the month, the previous month, for the next month. And also put the extra money towards that first debt only. You're going to make your regular payment on everything else, but you want to put all your extra funds towards the first debt that you decide to pay off. That's going back to our debt cancellation and debt management part. So tonight, we are going to really talk a lot about credit, and we're going to move right into home ownership. So I'll start off tonight. I'm Lucinda McLean, and I'll be covering the basics of credit. Some of the objectives, we're going to learn what is credit, the importance of credit, what is a credit score, what makes up your credit score, the parts of your credit report, and what you can do to improve your credit. So give you a couple minutes, make sure you have a pen or pencil and some paper and take some good notes. And also make sure you jot down your questions. We may go over your, say for instance, if you have a question, we might cover it, you know, as we go along, but please make sure you write down your questions. And also, Stephanie, you can interject, you know, whatever. So the first half of this is going to be about credit. So let's go ahead and get started. So the first thing that we need to know is, what is credit? So credit is a contract between you and a lender for a product or service that you are going to pay for in the future. You promise to repay it, and that's why there is a contract. It's money loan based off of your scores and your income, and credit should be an asset to all of us. Don't feel discouraged if you made some mistakes in the past, because all of us were not taught about credit when we were coming up. If you think about it, just from my own personal experience, whenever I was coming up, there was no discussion about money or credit in my household, and that's not shooting down my parents or anything like that, but credit was a total different thing when I was coming up in, I'll say the 80s and the 90s, so I won't tell my age, but credit was totally different. Our parents may not have been taught about credit because their parents had a different way of getting credit back then. Sometimes you can go and just your name, your family name would get you credit and different things like that. And that wasn't my situation, so I'm not going to talk about it, but credit was totally different. And so the discussions just trickled down. Before your parents' their parents didn't need credit. It was totally different. So if you made some mistakes along the way, you know, we're going to start today, and we're going to change that. We're going to change it.
Can I interject one quick thing?
Mm-hmm.
And one thing I think, one takeaway that you can actually apply to credit is basically having integrity. That you're doing exactly what you promised you were going to do. It's integrity. If you promised that you were going to pay a certain amount at a certain time, it's integrity. You know, and that integrity shows up on your credit report. But just remember that credit is integrity. That you are a man and a woman of your word, and that you're actually going to do what it is that you promised that lender or that borrower that you're actually going to do. It's having integrity.
The better your credit, the lower your interest rates. And the interest rate is the cost of credit. So when you hear about the interest rate discussions, if you are in the 700s, I should say maybe 700s higher, you're more likely to get a lower credit score. And that means less monies that you will have to pay back the banks or the lending institutions. You know, more of your money every month from that payment is going to go towards your principal balance. So you want to just write that down, that the interest rate is the cost of credit. And the better your credit, the lower your rate will be. I just want to talk about this myth right quick. So we'll talk about the myth of it is better to have no credit than bad credit. We hear this a lot. Well, I don't have bad credit because I don't have any credit. I feel like that's a myth, and that's my own personal opinion, because you cannot go to a bank, you go get a car sometimes, definitely can't get a house if you don't have any credit established. Just because you have a clean slate, that does not mean that you are credit worthy. You have to establish credit now in order to win the trust of the lenders. And you definitely want to interject, please. You have to have at least 3 credit trade lines that's been reporting at least a year to see how you're going to pay, to see if you're going to max out your credit cards. You know, they have to have a history in order to loan you that bigger amount of money. Even when I got my first car, I had a few credit cards and that was all, but I never had a car loan before. When I went to Sanford Honda, they said, oh, you need a cosigner. I said, why? Because I have good credit. And really, I had limited credit, even though there were no blemishes on it, and they still wanted me to have somebody to cosign. That means a cosigner is somebody that is going to say, if she doesn't pay the bill, I'm going to pay it for her. So they still wanted me to have that, even though I had limited credit or little to no credit. So it is a myth that it is better to have no credit than bad credit.
And I think probably back in, if you all remember back in 2008, that's whenever the market really, really crashed. Before then, there was what we call non-traditional credit, where you did not have to have a credit score. You can actually have water bill, cell phone bill that had your name or something like that on it, and they would take those things as showing, okay, I do see where you actually been paying, you got a good paying history. But since 2008, whenever nothing was really regulated, and so we went from one spectrum to the next spectrum. Now everything is regulated. So credit is a must. If you want to do anything, and if you want to make sure that you're actually getting a good rate, like what Lucinda said, and you're not paying money out the wazoo because you have bad credit, you want to make sure that you have a great credit score. And shoot for 700 or higher. The higher your score, like she said, the lower interest rates you're going to have, which will mean that's less money that you're going to have to put out.
We'll go right into the integrity part and continue to talk about how important it is to have credit. Great credit is important because now, because times have changed due to market, economy, different things like that, employers pull your credit now to see if they can trust you. It doesn't matter where you work at. Like we, of course, would get our credit pulled because we work in the banking industry. But if you want to go be a teacher or something like that, then they are still pulling your credit. So employers pull credit. Your utility deposits depend on how good your credit is or how good or bad. So the good people don't have to necessarily put down a deposit. But if you've had a poor credit history, then you might have to pay $200 to do energy or pay a water deposit. Now they have the insurance companies on your car insurance, and I touched on a little bit of this last week. Your premium, if you've seen an increase in your car premium, is very likely that your credit has been pulled. They don't do a hard inquiry, they do a soft inquiry, which we'll get to that later. But credit is very important from that aspect. Also, if you have built a positive credit history, if you don't have any money in savings, which our goal is to get you all to paying down debt and to saving and to building your credit, but if you don't have any money saved and you have really great credit, you still can sleep at night. And it gives you a peace of mind because if an emergency comes up and you don't have the money, you still have your credit to depend on. You know, I always say to have one credit card for that reason as well too, but you don't want to make a habit of depending on your credit for emergencies. But if you do have great credit, that is one source of a peace of mind for an emergency. I wanted to touch also on the types of credit. And the two I want to go over tonight is going to be installment and revolving. And all of this is building up to us reviewing the credit report and what that entails, because I don't want to do a lot of lingo and you don't know the terms, okay? So there are two types of credit that I want to discuss, and one is revolving and one is installment. Now the revolving is typically known as a line of credit. It automatically renews once you make your payment, so that money minus the interest becomes available for you to use at a future date. And some of those examples are credit cards, some furniture accounts like Badcock and Farmers Furniture, Rooms to Go, places like that. They have revolving accounts, home equity lines of credit, and anything else I might be missing. Those are the basic ones. So credit cards, or when you think of revolving credit, you think of credit cards, furniture bills, home equity lines of credit, things like that. And again, that is affectionately known as lines of credit. And then the installment loans. Installment loans, how you know the difference is they have a definite term or end date. Typically when you go get your car, you have a 60 months if it's a brand new car, or 3 years, or 72 months, what have you. But that has a definite end date. So when you look on your credit report that we'll go over later, and you see is I is for installment. And you have to have a good mixture of these types of accounts to better your credit score. I'll touch a little bit about that later as well. With each type of credit, it can be secured or unsecured. Unsecured notice means you signed your name on it, and they took your word that you were going to pay that money back. Whenever you sign that contract, it's unsecured. You signed a signature note. And then another is secured credit, and to help build your credit, you hear now secured credit cards. And security means it's a deposit, and you can kind of think about like when you buy a car. When you buy a car, a lender lets you drive off the lot because they have a lien on that car, and if something happens, they can repossess your car, take that car and resell it for some of the value. So thinking of a secured credit card is very similar because you pay a deposit amount, and then whatever your deposit is, they will extend you credit. Some places, whatever amount you put on the card is the amount of credit you have. Other places, you might pay $49 and they might extend to you $300 in credit to get you started. And that's for people that have challenged credit or you're trying to establish. Everybody all right so far? Okay. The next thing on the agenda, I want to talk about what is your credit score. So a credit score is a snapshot of how you manage your credit. that has been extended to you. So it lets lenders know that you're responsible or irresponsible. That's the first thing they're going to look at when they pull your credit is the credit score. They're not going to go into your credit reports. They're going to go straight to your credit score and say, oh, she has a 590. She's not being responsible for her credit. They're not looking at your story. They haven't heard your story yet. So it's a snapshot. The credit score is a snapshot of how you've handled your credit that has been extended to you over a period of time. The scores range from 0 to 850, and I want to kind of touch on that a little bit because FICO, which is Fair Isaacs Company's scoring system, it actually goes from 300 to 850. But I have seen in banking industry where you get a 0 because you don't have any credit at all. So as Stephanie said a little while ago, you want to shoot for at least a 700 credit score, and that will kind of get you what you need to get. People think you're very responsible when they see you in the 700s. That is a good credit score to have. So if you're looking for a goal to reach, 700 will be the goal for us. Some of your creditors that you pay, they do provide you with that FICO score for free. So your credit cards, if you have a Discover card or Capital One, different, whatever your credit card is, they provide them for free for you. Some of them are FICO scores and some of them are Vantage scores. You do have to look at the difference because places like Credit Karma, Credit Sesame that you might use on a regular basis that they're driving home to everybody right now is free, but it is not your FICO score. Your FICO score is what most lenders use to extend credit. So Credit Karma, Credit Sesame, they are very good tools to use, but you come to the bank to see Stephanie and you have a 720 on Credit Karma or Credit Sesame, and when she has the lending department to pull it, you might come in with a 670. And it's because the FICO system is totally different. So I want to go over the chart. So if everybody could pull out your credit at a glance pie chart.
If you hold it up, I'll,
You have yours from last week? And yours might be on black and white, and it's okay.
all right, I got it right here so that people can
So does everybody have your pie chart?
see it. If they don't, we got it on there.
All right. You want me to continue to hold it up?
Yeah.
Okay. All right, so I sent this pie chart to show you what your credit score is made up of. Ours is color coded. Even if yours is not color coded, it's okay because you can go by the percentages that I'm going to go over now. So your credit score, your snapshot of how you handle credit is made up of 5 different things. Oh, I'm moving it around. Sorry, y'all. So the first thing that you see, the largest area, yeah, thank you, 35% of your credit score is made up of your payment history. So that means, like Stephanie was saying earlier, your integrity. Whoever extended you credit, they are picking up this part of your score to say she has paid me on time every single month. So if you have a good credit score, that means you have had that integrity and you've done really well with paying your bills on time. The only thing that's required of you is your minimum payment. So don't get caught up in, I gotta pay some extra every month because that's what people tell you. The most important thing is right now is to pay your bills on time because that is the majority of your credit score. The next largest piece, is 30% of your credit score is the amount of credit that you owe. So this means your balances that you owe your creditors, the amount of credit that you owe. Excuse me. You want to keep your credit cards, your revolving credit, down 30% of your approved credit line. in order for this to have a positive effect on your credit score. So that's the amount of credit you owe to your lenders. So when I say your lenders, I'm not talking about the city of Sanford, Chatham County Utilities, or anything like that. I mean a credit card, somebody extends you credit to pay them in the future. How much you owe to these people. So if you start creeping up to 50%, you might have seen on Credit Karma where your score is dropping. Part of that may be because of how much you owe on your revolving credit, your installment loans, things like that. The most important piece is that revolving part, because the higher you owe, so for instance, if you have a $500 credit limit and you owe them $497, it looks like you're in financial distress, like you're stressed financially. You're using all your credit to survive, and you are beginning to look like a credit risk to your lenders. So in order to solve the problem of you getting new credit, your score is going to drop. That's the negative effect on maxing out credit cards and things like that. If you stop me anytime, okay? And then the next section you will see on there is 15%, and 15% is the length of your credit history. Right here.
Okay.
So 15% is the length of your credit history. How long you've been in the credit bureau. How long you've established this credit. The longer you've been in there, the more positive this affects your score. If you are going around and you want to save 15% at Old Navy, you're applying for credit, it's the Christmas season, you go to Belks and you want to do another one, you open those two credit cards, you're going to negatively affect that column, that 15%, because now you're opening new lines of credit. They are open right now, and it's brand new. And so a lender sees that. Say if you came to me for your mortgage, a mortgage loan, a lender sees that as a negative thing, because now it looks like you're in financial distress. Again, it goes back to all of these things when you're dependent on your credit to live, survive, to do the bare minimum, to get by every day. So you want to avoid opening up new credit unless it's absolutely necessary. The next column, the 10%, right here. You see it? I moved a little bit, sorry. Next column is the new credit. Same thing. All of these work together. So a new trade line, length of credit history is also affecting that Old Navy and that Belt card also just affected your your new credit column. So all of that's a negative effect on your credit. Now, don't get me wrong, eventually all of this stuff, as long as you're paying on time, you're keeping your balances low, it'll all work itself out eventually. So if you just open a new credit card, don't think I'm beating you up. Eventually just pay a minimum payment, and eventually it'll all level itself out. But right now, your credit is going to take a hit. You say, whoa, my credit score dropped on Credit Karma. It's because you just went to Belks, and now Belks is reporting 2 weeks later that you have a $300 credit line with them. Okay? So it can be a negative thing in the very beginning. And the last section right here is the type of credit you use, and that's why I wanted to go over those two types. And another type is your mortgage, which Stephanie is going to touch on mortgages a little bit later, home ownership. But your mortgage loan, installment credit, and revolving credit. You need to have a good blend in there. What do you think is a good blend? I say with an installment loan, maybe two credit cards,
right.
Not necessarily a mortgage, because everybody doesn't want to be a homeowner. So right. At least 3 trade lines, that's enough to build your credit. So what we just went over now is what your credit score is made up of. Again, you want to shoot for 700, and you want to stop shopping around for new credit. Don't do that just to save 10%. You don't want to pay for those Christmas items till next Christmas. All right.
And like Lucinda says, shoot for 700. It doesn't mean that's where you're staying. Okay, that's just a good place where you want to get to, and then always try to go for the max, which is 850, because the higher you score, it just frees you up to be able to do a lot more flexibility. And one thing that she actually talked about is risk. There's low risk and then there's high risk. Whenever a lender actually looks at your credit report, the risk factor is the higher your credit score is, you're considered a low risk, meaning that, okay, I can take a chance on this person because it's showing that they have good credit history, good integrity, good responsibility, that they're actually gonna do basically what they said they were gonna do. The lower your score, it means you are high risk, that they do not want to take a chance on you, but if they do take a chance on you, you're gonna pay out the yin yang. So you're gonna have a very, very high credit score. So that's the difference in low risk and high risk.
And then if you're high risk, you're more apt to have to use a card title for a loan. You're more apt to have to do the deposits on the credit cards and things like that, because they say, oh, she had an issue sometime or another and we wanted to do the business with her, but we need some security just in case. Yeah, so with the higher risk person. And even with the perfect credit score, we've touched on that a couple of times. Only the last time I looked, which is 2016, 0.05% of American people have a perfect score. So that goes to show you that you don't have to have a perfect credit score, but you want to shoot for perfection. Just like in our daily lives, we want to be the best we can be. We want to have the best credit score so that we can live our best lives, and we won't have to pay so much for the things that we desire. All right. If everybody will, no, I'm not gonna be able to hold this one up the whole time, okay, everybody? Your Equifax, your sample credit report. If everybody will pull out your sample credit report. So we've talked about what makes up your credit score, and now we want to move right into what does your credit report consist of? You said it can? Okay. So if everybody will pull that out, and we're not going to go through this page by page for time reasons, but we wanted to give you something to look at just in case there are people that have never seen a credit report. Now, we gave you Equifax. I did that on purpose because Equifax is one of the more pulled credit reports on the East Coast. So a lot of lenders report to Equifax, and so I wanted you to see what it actually looks like. Well, of course not yours, this is just a sample of what it looks like, because everybody definitely needs to pull and look at their credit reports. So Equifax is the most important of the three as of right now, until Stephanie tells you about home ownership. Let's just keep that in mind. And I'm just going to briefly go through it. If you want to take 1 minute, you can flip through and look and see what you see, just in case you have any questions about the credit report at the end. So write down your questions, just flip through. We'll give you 30 seconds to flip through. And then we'll go over the parts of your credit report. Oh, okay. I'll tell them to flip through their credit reports. All right. So the first thing you'll notice on that very first sheet, and I'll look at this with you all, is from Equifax. It has a confirmation number, as of what date, and it's available for 30 days. It gives you all the sections that you will go across. You'll come across, whenever you're looking at your credit report. And then it also has a graph somewhere in here that tells you how to read the parts of the credit history. So that's important too. Whenever you're looking over that tonight or this week or sometime or another, you can skim through and it'll actually tell you on here how to read that payment history. So I'm going to skip around on the sections, but for the most part, you can look at the very first page, as a matter of fact. It gives you a credit summary. It has your personal identifying information on there, such as your name, your current and previous addresses, your date of birth, your employment history, who you've worked for. Sometimes it has the titles on there that you have were in at those companies. It has your phone numbers on there that you've had since you had credit, and they're getting this information from the lenders. That's where this information is coming from. So any type of credit that you had extended to you, those creditors, those lenders, they are reporting this information to, for the sake of conversation, to Equifax. There are 3 different credit bureaus. Those Equifax, TransUnion, and Experian. But for the sake of conversation, we're going to focus on Equifax. They also contains public information such as collections, bankruptcies, judgments, foreclosures, tax liens, deficiency balances from a repossession. You might see that on there even though you may have never went to court. A judgment is normally placed when a lender takes you to court. That's on there. That is public information because it's filed at the clerk of courts. A collection item, we all may be familiar with a collection item. Say you went to Central Carolina Hospital because you broke your ankle and you were not able to pay all your monies in full. Literally, probably by the time you get out of there, they already sent you to collections. So they don't give you much time, but if you have a balance that you owe Central Carolina Hospital that your insurance didn't pay or that you weren't able to pay up front, they may send you to a collection agency. So they're going to try to collect the money from you first. If they can't collect it, they're going to sell it off to a collection agency and let them try to recoup most of their money. Collections and these judgments, the public information section, those things cost up to 20, 30 points. Those are very, very, very important to try not to let those things happen. We touched on this a little bit last week with the public records as far as collections. If you are one of the people that have a lot of medical expenses on there as far as collections, you can reach out to the hospital that you went to and ask them for financial assistance, a hardship program. They're not going to offer it to you. So you can reach out to them, ask them for an application, complete the application or get somebody to help you complete it, and then get your bank statements, whatever information they request of you, turn it back in and see if they can take some of those government funds and pay off some of your medical collections. Once they do that, which a lot of times they will depending on how your financial situation, they will actually remove those collections from your credit report within 30 days. You have just boosted your credit score because now that negative payment history is gone. So you've now increased your credit score because those collections are gone. Another section is the credit history. And again, there is a chart typically on here that shows you how to read your payment history. I can go over one. Okay. So if you will flip to page 3, we'll go over Wells Fargo. Page 3 of your Equifax credit report. So what you see here in this section of your credit history, your pay history with Wells Fargo, their contact information. That's the first thing you see. Their contact information. The next thing is the account number. The account numbers and things like that are missing because of privacy. This is an example, but most of the time it might be X'd all the way out until the last 5 or last 4. They have your account number, your current status, the next to the right, pays as agrees. That means currently you are on time. You have made your monthly payment on time within the 30-day mark, I should say, because even though you might be 10 days late, it still pays as agrees in their eyes, because once you go past 30 days, that's whenever the negative stuff starts reporting. So they give you a month. And then you're the account holder. It's an individual account. $5,000 is what you owe. The high credit. The high credit is what they've extended to you. On here is not a credit limit, so let's see. It's got to be installment loan. Education loan. This is an education loan, so the type of loan, the date of your last activity, how many months you've been paying them, the date of your last payment is sometimes filled in, the date you open it, the last date reported, and every lender does not report every single month. Some lenders report every 2 months. It just depends on what they decide. And you might not see Wells Fargo on Experian or TransUnion because they might not report to them. So Equifax right now is who we're going to focus on again. If it was charged off, a charge off means that the company took a loss. They charged off, you're not going to pay them. They took a loss, they've written it off. So that's what a charge off is. And then down in the graph where you see the stars, all the stars mean you paid on time. That's what that means on there. And then if you look at 2009 in October, that number 60, that means they were 60 days late then. But in November, they caught it up. December, they caught it. They've been on time every month since then. So sometimes you might see a 30, 90, charge off, status P&L, which means profit and loss, they charge you off. They've written it off, they're done with it. You probably sell it to a collection agency, those type of things. And then you'll see the inquiry section on your credit report. An inquiry is whenever you went to Belk, whenever you went to Old Navy, and those people at the register took your information, they pulled your credit report. That's an inquiry. Anytime you go to a creditor and they pull your credit, that puts an inquiry. An inquiry is up to 5 points each. They last 2 years on your credit report. So if you see a lot of inquiries, that means a lender's thinking, oh, she's searching for money. She's in financial distress. Something's going on with him. You know, it just sets off a red flag. So you want to keep 1 to 2 inquiries or none at all. Don't have your credit pool because, again, that affects your credit score. The inquiries affect your credit score because you're shopping around for new credit. Let's see, your address to the creditors, general information. If you'll see the blue hyperlinks on that first section, the blue is things that you can click on. So you can click on your rights under state law, how to remedy identity theft. All of these things are on your credit report. Those are towards the end typically, but if you're online reviewing your credit report, that's where the blue on here comes from. So you can just click right on it and it'll take you to each section. Okay? And keep in mind that each report will look different. You know, a lot of times if you've ever had all 3 of your credit scores pulled, you will have 3 different scores, and that's because everybody does a report to each credit bureau. And then, for example, the State Employees Credit Union. State Employees Credit Union only uses Equifax, so you will not see them on TransUnion, you will not see them on Experian. You can get your credit reports free once a year, and make sure you write this down, all 3, at www.annualcreditreport.com. So that is www.annualcreditreport.com. You get all 3 of your credit reports free every 12 months. Okay? I'm gonna have to wrap this up. It's getting lengthy. We're really pushed for time, and Stephanie needs to do her her presentation. So I'm gonna kind of go through this. Yeah. Okay. So I'm gonna go through this last section, and that's how to improve your credit scores. This is very basic information. How to improve your credit scores. Pay down your debt. If you pay off a credit card, do not close it. Keep it open, let it stay there. If you're tempted to use it, cut it up. Don't close your credit lines. Stop having your credit pool inquiries count to 5 points apiece. Every time you do that, it lowers your credit score. Every time you open the account, your score is going to drop. So don't have your credit pulled often. Pay all of your bills on time. Goes back to the integrity piece. If they loan you the money, at least pay the minimum payment. If your statement comes in the mail, go ahead and pay them by that due date. If you're behind right now, it's very important that you catch up. That's the first thing you want to do. Focus, tunnel vision on catching up. You want to catch up because 35% of your credit score is your payment history, so catch up. Don't get obsessed with your credit scores. It's also important to have a healthy credit report. That's the reason why we wanted you to see what's in here, because we work in banking and you can have a 700 or higher and still get turned down because of negative history in your credit report. So don't get obsessed with that. Don't pull Credit Karma every 7 days. I don't care if they do send you the email right now. Get caught up. Focus on, fixing inaccuracies in your credit report. So that, which leads right into the next thing. I made you a sample. If you will get out your handout on the sample dispute letter. This is the last thing I'll go over tonight. The sample dispute letter. So in my sample, and this is literally, don't put verbatim what I put. You can write whatever your situation is in here. So in here in this dispute letter, oh, I'm sorry. You notice that I have the date, so you want to date it. Who is going to, and I do apologize for not being consistent. It says the TransUnion, but Equifax, we'll put them there for tonight. And the file number came directly off of the first page of your credit report. So on here's the confirmation number. You can use that to replace file number, however the wording is. And then I just put the whom it may concern. And so you can put the situation. I put on here, I just pulled my credit report and I know it's a collection account from Resolve Partners, LLC. And put the partial account number on there. This is not my account. So there's multiple reasons you can dispute. The Fair Credit Reporting Act says that everybody, all your lenders, have to report accurate information. So if anything is inaccurate, you want to put it in this letter. What is inaccurate? And then I plead with the case in here. I put, I've never had a contact with this company. They never sent me any information. Please remove this account from my credit file. When you remove that from your credit file, that means your score just went up. And they have to provide proof of how they validated it to you. So they might come back and say, as a result, we found that this is your account and all the information is accurate. If it comes back, you write a note right back using that same thing, and you're gonna send it right back in and say, I request that you send me what you verified my account information by. They have to prove that, and they have 15 days to do it. All right? And just keep in mind that whenever you send in a dispute, they have 30 to 45 days to respond. And I say 45 days because if you use the free credit reports from annualcreditreport.com that I gave you just a minute ago, then they have up to 45 days and not 30. So don't get in a panic when you don't receive an answer back within 30 days. And so I know I gave you a lot of information. Hopefully you'll have some questions for me. And I'm going to turn it over to Stephanie Peterkin now so that she can go over home ownership. Because if we build our scores up and get our credit reports accurate, then you can become a homeowner.
So let me, facilitator, Vicky, let me ask you, we're supposed to end at 7.
Okay.
Yeah.
So do you want, we can actually just kind of see if they have any questions for Lucinda, and I can always do home ownership
Yes.
next.
Yes. I apologize.
Okay.
So you let me know how you, no, that was a lot of information. You knew that was gonna take a lot of time, so it was really good information.
That was basic information. I'm sorry, I didn't mean to rob you of home ownership piece.
No.
So if you have any questions, you can submit them now. And annualcreditreport.com for your free credit reports. You do not get your scores for free. Do not buy those scores off of there because they are Vantage scores. Save your $7.95. If you want to order your credit score, order them off of myfico.com. That's my recommendation. myfico.com. You got a recommendation for that? You got any other source for a credit score, FICO score?
My platform's different, it's all that, so I'm not familiar with it.
Oh, okay.
Yeah, I mean, you said, yeah.
If you want an idea, myfico.com. Don't just pull your credit because you want to know what your scores are. Don't do that because you just affected your credit score. by shopping around. You think anything else on this basic information?
This is what someone's question kind of is that.
I'm gonna let you read that too before I give you the answer, before I address that. That made me nervous. They're talking about a corporate attorney. I'm gonna read it out. I'm not an attorney. Okay, so this question, and you know, I'm not here to give you this type of advice. I want to say that first. This made me very nervous because your corporate attorney told you this, so, and I am not practicing law. I want to give out that disclaimer. What we're doing tonight, we're just cleaning up, trying to clean these inaccuracies up. But the question, the statement first says, someone's corporate attorney said, I quote, do not demand validation of the debt, end quote. Only say that, quote, dispute the debt, don't demand validation. In my opinion, this is my opinion, consult that, go back to that attorney. They need to explain why they said that. Because FCRA, which is a Fair Credit Reporting Act, says that a lender has to report 100% accurate information. If that letter comes back and it says that's your debt, you're stuck with that on your credit report. So in my opinion, because you are entitled to an explanation, you should request how they validated that information, your payment history, your high credit, the dates that are in here. How did they prove that is 100% accurate? I would want to know, especially if you're disputing it, because you sent the letter with the intention of having it removed because it's inaccurate or updated. Sometimes they won't remove it, they'll just update it and say, okay, yeah, it wasn't accurate, but now I'm sending you this free credit report because we updated it. Here's your results because we updated it. I would go back to this corporate attorney. I'm not here to give legal advice, but if you want to know how they validated that debt and said it is yours, it's 100% accurate, you have the right to know how they confirmed that information. I won't touch that with a 10-foot pole. Y'all not gonna get me sued. You can get me in trouble. That's all? It's the only question? Wow. Either I did a terrible job or I did a fantastic job, and I'm gonna stay positive and say I did a great job. So let's just go back then, since we still have 30 minutes now. Let's just go back over.
We have 30 minutes? I thought we were at 7.
It is at 7 weeks at 30.
Okay. Well, I can
half an hour.
Yeah. Yeah.
Okay, well, I can do, if you want me to do the home ownership portion.
Yeah, right now we don't have any questions coming in,
Mhm.
so I think, Mary Harris has a question.
Okay.
How long does it take for a dispute to be resolved?
They
Can you
have,
repeat it?
for a dispute to be resolved, it takes 30 to 45 days. If you are ordering your credit reports off of a site that is not www.annualcreditreport.com, then they have 30 days. If you order it off of there, it's 45 days. It could be way sooner than that. They can send you something in 2 weeks, but they have up to 45 days to respond to your request.
And then I think, since we don't have a lot of other questions, I think we should go on to home ownership. And then if we have a lot of questions at the end, we can have people collect those for next time or
Okay.
something.
Right.
Okay.
And also, like she said, it could take 30 to 45 days to resolve it. But it's still, but if you're talking about total resolution, meaning it could take several rounds of disputing, which means it could take actually 3 or 4 or 5 months.
Yeah.
So when I work with my clients, we get results as early as 2 months, but it literally can be a 3, 4, 5-month process. And what folks need to understand is you didn't mess up your credit overnight,
Amen.
and you don't get it fixed overnight.
That's right.
So it takes proper planning, it takes time, and you know, as I coach clients as well, we talk about, I put it as a game. Credit is a game that we didn't invent it, it was put on us. So they're being very lenient because they say 700. I coach my clients to go for 725. Because that way if we miss 700, 725, we're still in the 700s, okay? And we talk about miss. Most folks will say, oh, I have a bankruptcy and it has to stay on my credit report in 7 to 10 years. The fact of the matter is it does not have to stay on your report for any longer than it needs to stay on your report. The fact is a bankruptcy or a foreclosure, it has to come off your report after a 10-year period or 7-year period, okay? But you can dispute any of that beforehand and get it removed before that time. So some folks have a bankruptcy and say, oh, well, I can't do anything, and it's not mine, so I'll let it fall off in 10 years. No, that you can dispute it from day one and get it off immediately. There are just several other, again, myths that have become truths in the industry that is not accurate. Also, what is key, as I service my clients that want to buy homes, they will use Credit Karma as an indication of their readiness to buy a home. And like Lucinda said, that is about as the most inaccurate information as you can possibly get because they use an educational algorithm. They don't use what the lender uses. To be specific, not only do we have 3 FICO scores, TransUnion, Equifax, and Experian, and by the way, Experian is located in Ireland, by the way, we also have 4 other FICO scores, all right, that there are different algorithms. We have a specific auto FICO score, we have a mortgage FICO score, which banks and lenders use, obviously in home ownership. We also have an insurance FICO score. So I do life insurance with folks, and I've had people get turned down for life insurance because their FICO score is not according to the FICO score that the insurance company has. And we also have an employment FICO score, but it's really a letter grade. So if you are in a financial services industry and things of that nature, or high security, you will most definitely be affected. So just be aware there are several other scores out there, not just the 3 FICO scores that we're talking about.
So any questions?
No. That's it. Okay, ready?
Okay, all right. Hi, my name is Stephanie Peterkin, and I'm going to talk briefly about homeownership. Homeownership is one of the best things that you can actually do, and it's one of the major and largest purchases that a person will make in their life. So you want to make sure that you are ready to become a homeowner. So, and I take this very, very seriously. One of the reasons I actually became a realtor is because I just had customers, or I was working with customers or family members or friends that actually had a very bad experience whenever it became to purchasing a home. They were told erroneous information, they were taken advantage of, and it was just, and it shouldn't have to be like that. Home ownership, the process of buying a home, should be one of the best experiences that you should ever have in your life. It should be a very, very enjoyable time because you're having a chance to actually dream. It's something that you aspire for, something that you should work towards, and that now all the money and the hard work that you've actually did to get to this point is going to be, you know, you're going to have something to show for it. So that should be a great experience. It should be nothing. When I hear people having a very terrible time with the home process, you know, it really grieves my spirit because it should not be like that. So again, buying a home is one of the largest purchases that a person will ever make. So we want to make sure that you're doing it right. There's benefits of owning a home, and then there's benefits of not being a homeowner. So the benefits of owning a home is that you have privacy. It's usually a very good investment. If it's done right, it's a very good investment. You have stability, and you take pride in ownership and also community. So it's something that you can take pride in, and also you begin to develop community. You're actually learning your neighbors. You have a solid footing there. And also too, you have tax incentives as well as it builds equity. Now, if you wanted to compare that to renting, there's no responsibility for repairs or maintenance. That doesn't fall on you. In renting, there's flexibility, and renting also a short-time commitment. Let me go back and actually talk about the things that we're going to talk about when it comes to homeownership. I should have given you my objectives. The objectives that we're going to talk about for homeownership is the process of homeownership, becoming buyer ready, how to choose a realtor, and the pros and cons of homeownership and renting. And so I was just telling you there about the pros for homeownership and also for renting. So whenever it comes to homeownership, this is something I want you all to think about. Dream, dream, dream. Just let it go. Just dream. What is it that you want in a home? Just write it down. Just dream about it, okay? Then reality has set in. Okay?
True story. True story. New homeowner. Reality.
There's nothing wrong with dreaming. Dream, dream, dream. What is it that you want? Where do you want to live? How do you want your house to look? What size do you want? You know, what kind of neighborhood do you want to live in? What is your square footage? What colors do you want? Do you want hardwood floors? Just dream. You want, you know, how old do you want it? How new do you want it? Dream. Then once you get finished dreaming, reality set in. You have to have a plan. You got a plan. All right, so let's come up with a plan. And the first thing that you want to do when it comes to homeownership is that you want to get pre-approved. Now, there is a difference when you get pre-approved and pre-qualified. And I want to talk about that. Pre-qualification, just because you get pre-qualified, that does not mean that you're actually in a position to purchase a home. Pre-qualification is basically you're just giving your information to the lender. Nothing has been verified. So you're just letting them know this is where I work, this is how much money I make. So nothing has been verified, nothing has been validated. Okay, so it holds no water basically. So pre-qualification is just an estimate of how much you can afford in a mortgage. It's nothing that's been validated. A pre-approval, that's a little more extensive, but neither one of those actually give you, say that, okay, you've been approved to actually purchase a home. But a pre-approval is more extensive. We're saying that these things have been verified, but nothing, your credit has been pulled, and that you know, your employment history has been verified, things like that. So your title hasn't been, the appraisal hasn't been done, a title search hasn't been given, but all the other things as far as the process of actually becoming a homeowner, all those things have been done. So you want to make sure that you get pre-approved first, because the pre-approval is going to tell you how much of a house you actually qualify for. Mm-hmm. So that way, you'll know, instead of looking at a $500,000 home, when you should be looking at a $100,000 home. and also too, it's going to say, and most of the time, I've learned this, you know, since I became a realtor back in 2003, you know, has so much zeal and just really wanted to show people a home and everything, and did not have a pre-approval, and come to find out the person doesn't even qualify to purchase a home at all. So I've learned that over the years, realtors are not going to show you a property and you have not been pre-approved for it. Okay, you're wasting their time, and you're actually wasting your time as well. Okay, so
I'm gonna just interject there if you don't mind.
No.
I'm just gonna say this one thing. Don't go looking for the house first.
No.
Without that, because you'll fall in love with the house that you can afford.
Yeah.
I've been there and done that. So
Yeah.
listen to what she's saying. Go get your pre-approval first. That way, that's right. That way you would not be brokenhearted and discouraged from looking for your first home.
Right. And how do you go get pre-approved? Go to your bank. Mm-hmm. You know, the person that you're actually, we talked about the relationship whenever you open an account, mm-hmm. and how the personal banker or the representative there, they want to make sure that they go through every phase, every stage of life with you. So go to your bank and let the person know, look, I'm looking for a home. I want to purchase a home. What is the process of that? Tell me what I need to do. So go to them and get pre-approved. And that's the first thing. Get pre-approved by your lender, and they can say, okay, this is how much of a house you actually qualify for. Now, just because you qualify for $200,000, it doesn't mean you have to max out $200,000. Okay, that's the limit. That's just saying you qualify up to that amount. You can actually find a house for $150,000. So don't think that just because you qualify for the max that you have to take that. Okay?
That's good.
Do you have anything?
No, that was good. That was great. No,
Okay.
no, keep going.
Okay, so you want to get pre-approved. So once you actually get pre-approved for a home, then you want to actually find you a realtor. Okay, so you can actually ask a family member, you know, or friends, you know, who do you know of a good realtor? Do you know someone? Because you want to make sure that you trust that person.
Stephanie Peterkin.
Yeah, or you can come to me, Stephanie. But the thing is, you want to make sure that you trust that person. You want to make sure, and I know it says that, you know, a lot of people, how long have they been in the market? You know, how long have they had their license? And, well, you can, that does matter to a certain extent, but I think integrity has a lot to do with it. Whenever you're a realtor, you want to make sure that it should be about the customer. It's not always about the money, but it's making sure that that customer has a great experience and that you have an opportunity to make this person have a great experience with home ownership, so that whenever they actually close on their home, you can say, well, I took a part in that, of helping this person actually get to the next level in life or something that they can really, really enjoy. So make sure that you find a good realtor. Okay, ask family, ask friends. You can actually Google if you want. But that would be the safest thing, to ask family, ask friends, and also to go to your banker again. You know, they usually do presentations at real estate companies, so they'll be a good referral for you, a good referral source that you can actually go and get a realtor.
From a home buyers workshop, if you have some of those in the local area, the realtors that work in the area, they normally do the free home buyers workshop. Just you can see what the type of person they are, how knowledgeable they are as well.
And have a consultation. Once you find that, have a consultation. It doesn't mean just because you're actually going to meet with that particular realtor that you have to sign a contract with them.
Amen.
You know, just have a consultation. Look at several realtors. It's their responsibility to make sure that they actually are doing what they need to do in order to get your business. And whenever you actually go see a realtor, the normal commission for most realtors is 6% for residential. 6% for residential. So, and normally that's a non-negotiable, because I say non-negotiable because they're actually, that's what they're actually worth that. I don't think you can actually put, but that's I guess within the normal range of what, you know, commissions are. But, you know, you don't want to negotiate that, because that's that person's livelihood, you know, and if they should be worth that much. And most of the time, whenever it's 6%, they're going to split that anyway. It's going to be split with the buyer's agent, you know, so you have a seller's agent and a buyer's agent. So it's normally going to be split with the other person who's actually listing the property. So it's normally 3-3, so it's only 3% that person is actually going to be getting. I'm talking about the realtor. But that is normally the commission, that's 6%. But if it's actually split, and I'll start getting into that a little bit, if it's split, it's going to be 3% that the realtor is actually going to be paying. But that's not coming out your pocket. That's actually going to be coming out of the listing, the seller's pocket. So if they actually have they've already compensated that into the sale of their home. So if they're selling their home for $200,000, and they know they want to get back probably 190 or 180, they've already compensated for that 6% commission in that sales price. Okay, so that's not anything that you have to actually worry about. So do your due diligence. Make sure that you actually go and find your realtor. Sit down and talk to that realtor. Again, you're not obligated to actually stay with that particular realtor until you get that, well, I really like this person. I think this person is going to do me well. Then at that particular point, they're going to have you to sign what you call an exclusive contract, meaning that that person is going to be representing you whatever time period you all agree upon, normally 6 months to a year. And so that means that you are not, and I say that you are not saying that you can't, but you should not. Okay, as a realtor, we do what we call code of ethics. And that means that if another realtor knows that you're working with a client, and you ask them, have you signed an exclusive agency agreement with them, and they know that you have, you should not be touching that, customer. Okay, so most of the time, if you've already signed an exclusive agreement with them, you should not be going to another realtor. You should stay with that person that you signed that contract with, because it's their responsibility to make sure that any houses that you may find, you need to actually get back in contact with them. Do not call someone else, another realtor or another listing. You refer back to the realtor that's actually representing you.
Because that person that you signed with is still going to get paid, right? Regardless. Or do they still get paid?
It should, unless they, yeah.
You have to get a release.
Exactly.
Just,
Yeah.
sorry, y'all.
Yeah.
But, yeah, it gets touchy.
It gets touchy,
Mhm.
yeah. So the code of ethics, if you know that person is already listed with someone, signed an exclusive agreement, leave them alone.
Mhm.
You know, just do the right thing, going back to integrity. Going back to integrity.
It's real easy.
It's real easy, exactly, exactly. So once you have that, do you have anything you want to?
This is good. I wish I'd had somebody tell me this when I bought my house. This is great.
Yeah. And so normally once, a good realtor, once they actually sit down with the person, they normally tell them about the process. Okay, whenever you're having your consultation, they say, because they're really a novice, they don't know what's going on. So you want to say, well, this is how the process works. This is what you're actually going to be looking at. So by that time, hopefully, you would have gotten pre-approved. And so the realtor says, okay, so I see that you have been pre-approved. What we want to do now is actually go and look for a house. And the realtor says, okay, just like I told you before, dream. What is it that you want? You know, but make sure now that it's in the confines of what you actually been pre-approved for. And so they will actually start you to look for a house. You know, you want to make sure that, you know, you look at certain things as far as what neighborhood do you want to be in. If there's going to be any type of development that's actually going to be coming there, you know, do you want to stay in a school district? Is there a plant that's coming in there? Is there, so all those things your realtor should be very knowledgeable about, because you don't want the value of your home to decrease. Okay, so you want to think about that. So whenever you actually go and purchase a home, you want to look at the longevity. And normally, most people say you want to stay in your home at least 3 to 5 years to make sure that you get the most out of you actually being a homeowner. So whenever you actually start looking at home, think about those things. You know, make sure that there's no zoning that's actually going to be taking place where you may be losing some of your property. You know, is it going to be at a church that's going to be being built, something that's going to be being built that's going to decrease the value of your home? So think about those things, okay? So whenever you go to actually look for a home, if it's something that you like, you know, if it's something that you like and something that you say, well, you want the realtor to put an offer on, say, this is something that I like, I want to make an offer on this. If you're serious about the house, make sure that you don't do any lowball offers. So if you have a house that's $200,000 and then you lowball for $150, you're not a serious buyer.
You're going to insult that person selling the house.
Exactly. And the realtor should tell you that. That's an insult. Okay, you don't want to get into a bidding war, so know your limit. You know, if you make an offer on the house and then the person comes back, you make a $200,000 offer full price, the person comes back and say, well, you know what, we've had a lot of offers on this house, so, you know, the best offer, you know, 210, 215. Well, if you know your limit is 200,000, there's no need for you to. So don't get set on a house, you know, and you know, just stay with your plan. Stay with your plan and with your goal in mind. Just don't get set because you get in a bidding war and say, no, that's not within your budget. So no.
I want to say something about the offer.
Yeah. Go ahead.
Just from previous experience too, even in the offer, sometimes the houses come with appliances, sometimes they don't.
Mm-hmm.
Those are things that you can negotiate, appliances, fencing, if you want to change the color and something, if you want to change the carpet or hardwood, depending on if it's a new build or not, it's a lot of things that go in that offer.
Right.
So if you see something that you know you might can afford to get the appliances, you can ask them to put that in the offer.
Right.
Not necessarily saying they're going to take it, but you can negotiate that stuff.
And you know what? It's bad to actually think that you have to think the way I'm getting ready to say.
Yeah.
Sometimes, you know, I haven't come across this often, but I know that this does happen every now and then. If there are appliances or things like that that you like, and you do like that particular appliance that's actually in the house, you want to be very specific. and writing down the serial number, whatever type of, whatever type of appliance that is, so they won't actually change it out. I mean, I've seen that happen before, so you want to be really specific. If there are certain things that you like, make sure that you have your reel to be very specific. I want to keep this appliance here, so make sure you get the serial number, appliance such and such, or stove such and such, or ceiling fan such and such, or chandelier such and such. You want to make sure that you be very specific. Because sometimes they can say, well, you just said an appliance. There's an appliance right there. It's not the appliance that you said you wanted, so be very specific when it comes.
I'm not gonna give you your refrigerator.
When it actually comes to that. So you want to make sure that your realtor is aware of that. You have to be very specific. So again, if you don't know your budget, know where you are with your plan. Don't get into a bidding war. Don't get stuck on just, I want this house, I need this house. I always say what God has for you is for you. You don't have to worry about that. If it's not meant for you, God has something better for you. Okay, so just kind of keep that in mind. So whenever you actually find a house that you actually want, what's going to happen from that point? An offer would be made. Say that it was accepted. Your offer was accepted. Should we welcome
I've asked people if they have questions.
Okay.
Nobody's sending it in, so
Okay.
I'll
Okay.
take them and I'll be asking.
Okay, all right. So say that your offer was accepted on your home. Once that offer has been accepted, at that particular time, whenever you actually got a pre-approval from a lender, the lender should have told you what type of mortgage you were going to qualify for. Whether it's an FHA, VA, that's a veteran's mortgage, conventional, USDA, what else? Could be a bridge loan where you have to sell this house in order to get another home. Can you think of another one?
NC housing.
Yeah. So the lender should have gone over with you as far as what type of mortgage you actually qualify for. Now, first-time home buyer, you have USDA 100% financing where you don't have to put anything down. You just have to worry about the appraisal. So it's a lot of different things out there. So make sure that the lender, again, that's why it's so important to have a relationship with your bank. It goes back to having, whenever you open up that checking account, it's just not about a checking account. It's about having a relationship, a good ongoing relationship with your bank. So whenever you go to that bank, go to the banker, you want to let them know, look, I'm a first-time home buyer, I'm a novice, I don't have anything, do you have anything to put down? They should be asking you all those important questions. You may not have anything to put down. Banks offer, incentives as far as, they can give you money towards your closing. So those are a lot of things. It's so important that you develop a relationship with your bank. If you do not have a bank account, if you do not bank with anyone, come to Capital Bank.
That's right.
And you can come and bank with us, and we will make sure that we do you right. So you want to make sure that you have a good relationship with your banker, because this is going to make this process a lot easier for you. So once you actually do that, do I need to be wrapping it up?
All right, I told everyone it's 7:30, so if you want to be wrapping up, and I'm trying to take questions.
Okay,
So-
all right. I can stop right there, because that's a whole nother thing when you start going into as far as what the documentations that they actually need to start bringing.
So we'll have to do that at the
Next-
beginning
yeah.
of next time.
Yeah, that'd be good.
Right?
Yeah, that's
All right, so
gonna take a
ask
lot
one
of
more time if anybody has questions.
Does anybody have
Did you wanna add
any
anything
questions?
on that? It's your realtor.
Oh, I want to add something, actually. Whenever she was talking about the lending piece, going back to credit, they will pull all 3 credit reports, credit scores.
Yes, primary.
So the real estate lending score, which he touched on a little bit earlier, I'm sorry, I can't remember the name. But they will pull all 3 and take your middle credit score. So that cleanup we were talking about a little bit earlier, then if you're kind of consistent, you shouldn't have an issue. But they're going to take the best score out of the 3, depending on where you go. State Employees Credit Union only pulls Equifax. Some USDA sites only pull TransUnion. So that's one thing that you want to ask too. But you want to make sure all 3 credit reports have been are kind of consistent, because they're going to pull all 3 and take the best score out of the 3 to set your interest rate.
Yeah, so make sure that whenever you are a first-time home buyer, that you do not get, and this is actually what happened with the 2008 crash. A lot of people got into adjustable rate mortgages. So whenever you're a first-time home buyer, make sure you get a fixed rate. Okay, that your mortgage does, your interest rate does not adjust. What happened in 2008 was that a lot of lenders put customers in what we call an ARM, an adjustable rate mortgage. They were fine at that particular time because normally at that particular time the interest rate is lower. You know, you don't have to put, and make sure I'm saying this right because I'm trying to recall. With an ARM, the interest rate is normally lower. You know, the term is, well, it's normally a 30-year, but the interest rate is lower. Sometimes, well, it was a lot of variables that went into 2008 because stated income and all that stuff was then too, where you could state what you make if you had a great credit score, and you didn't necessarily make that. But anyway, make sure that you do not get into an ARM because it's going to adjust. An ARM will normally adjust every 3 years, 5 years, 6 years, 7 years, and then it can adjust to whatever that little board, that ceiling is, and it can actually knock you out from how much, from you being able to pay it. You know, so you don't want to do that. Stay away from adjustable rate mortgages. Always, always, always get a fixed rate mortgage.
And they make it look very attractive because sometimes
Yeah.
it's 2.75
Yeah, it's a lot,
or something
the interest
whenever
rate
you
is a
first
lot
start
lower.
out. They make it look very attractive, so you have to
Right.
beware of that.
Right.
It jump up to 5 after
Yeah,
that.
it can knock your payment way out and you won't be able to afford it. Then you can wind up just going into foreclosure and stuff
Right.
like that.
You have to know your risk when it comes to lending in different products.
Yeah.
And that's again where a bank will tell you, your
Right.
banker will tell you the pros and cons of each one, and
Ask a lot of questions.
and that's very, very important. Very, very important.
Yeah, ask a lot of questions. No question is a dumb question. That realtor, that lender, they're there to help you. So don't be afraid to ask any questions. This is your 30-year commitment,
Right.
15-year commitment.
Yeah, that's what it says, one of the largest purchases you're gonna ever make. So make sure that you're very knowledgeable about what's going on and seek help.
So we're gonna wrap it up, and they can't hear me, I don't think.
Okay.
Tell them to write down their questions, and we'll address them at the beginning of next
Yeah,
week.
so guys, this has been great, excellent stuff. I got to meet Lucinda and Stephanie. Definitely looking forward to talking to them more, and it was very, very good stuff. I'd like to congratulate everybody for being on this call because the average American only spends 15 minutes a year on their finances.
Wow.
And we've already spent an hour and a half, so we are about 6 times better than everybody else. And, but it's all about putting the plan and setting a goal, like you guys said, being smart. Those are key things. Credit, also looking for a home, finding a good realtor, and getting, but the key to that, guys, get pre-approved first.
Right.
That's right.
All right? Buying a house is stressful enough.
Exactly.
Okay? Take care of the money first. It gets a lot easier. But if you fall in love with something, nobody likes to be rejected.
Exactly.
We don't like to go on a date and be rejected, so you don't want to be rejected from the home you love. All right? Get the money first, then fall in love second.
Right.
Okay? That's the bottom line.
I love that.
All right?
Guys,
Thank
All right,
you.
thank you. Have a good night. See you next week.
All right, good job, everyone.
This was good. I ain't lying. I'm like,